Hey all. So this is our second video, uh, following up our first video talking about the market decline in 2000 that we saw previously, and the market decline um, that we're going to look at today is going to be the 2008. And then we're going to actually contrast a little bit of the differences between the two. So if you haven't seen the first one, maybe have a look at the first video. And then we're actually going to have a look at what we see in today's particular market. So um, the major difference between the market in 2000 and 2007-8 was that we had this crazy sort of low volatility, euphoric buying type of environment, and so it's from a from a second derivative or 2D modeling perspective, it's almost the exact opposite. That we were actually peaked. Our modeling had actually started to break down, and the equity curve started to decline or go below the on-off switch, meaning that we tend to have like more protracted moves, and in particular tended to as an example, when the system went short and the equity curve's down in here again, if you understand the concept of 2D modeling, that's actually not, it's considered a long trade. And so we were, this whole period from, almost end of 2006 to, sometime in late 2009, you were basically only supposed to go against what the trading system said based on our flip modeling concept, which yielded a fairly substantial amount of gain, you know, uh, by utilizing different, either inverse ETFs. But that's something that we can talk about another time. So in this particular case, again, we're going to kind of use the same, logic that we worked with in the past. I'm going to kind of give you, the difference between, where the trend rank turned into a sell and, didn't flip back into a buy. And again, we use this line. So what we can see is that in this particular case, our trend ranking was pretty strong. And so we had very, very strong trend ranking data. Basically, from this point here, our trend ranking was, at this point, in the market from 2000, from 10 2006, all the way through until probably, the peak in 2007 for a year, there was no real reason for investors to actually get out of the market. Simply just weather the storm, let things go down. That's it. So in the fall of 2007, we saw, sort of the first crack in the armor, which was a sell-off in the market, and the sell-off was actually probably about pretty close to 15%, 14, 15%. Took place over a couple of months in 2007, as different things started to happen. But at that particular point, we were still not showing any kind of breakdown. And this is kind of a really important thing for investors to understand, because especially in today's world, most people, as I said before, Wall Street is eternally bullish. They are eternally optimistic. And the fact of the matter is that money continues to always make its way into investment products, and so people just use this as an opportunity to buy. They bought the dip, and the market actually began to rally. And we can kind of show you from a perspective of, how our you know trend models, or tactical stuff, was sort of shifting stuff around at that particular point. But the first point at this point right here was, the reading on this is roughly around, I think the high that we got on the actual index itself was somewhere around 156, 157, and the trigger for us to sort of get out into the market was around 152, 51. So basically, we ended up losing about 7 points on 150, so roughly about 3.5% from the high. And from this particular point right here, we did not see our trend ranking fall anywhere back to positive until this point. So again, we did give up, we did miss a fair chunk of what we saw at the bottom of the market. Although there, and potentially there are always signs that show that some of this behavior has occurred and can kind of help us. But at the end of the day, investors are able to walk away from a 55% decline by only, sitting in cash at, with a 3% loss, and then a year and a half or 2.5 years later, then come get back into the market after the decline, and then start to focus on seeing the equity market rise. So at the same point, that I want to make is that what do we tend to see as the market began to rally? And I think that it's critically important, because I expect when we talk about what's happening in the market today, that generally the idea is that you have to see and sit through this entire period of decline that occurs right here, and then wait and see what happens. When we had about a 9% decline, 9 months ago, the market just immediately rocketed back up and just kept going. And so there was no real breakdown in sort of the trend modeling, and so as you'll be able to see, you were able to take advantage of just staying in the market, staying pat, living with that, because your opportunity to rotate out is still coming, in my mind, and we've not been that far from new highs. So in the case of the market, back in 2008, what was happening is that the most of the algo information or data was actually not working particularly well. And so what we can see is that unlike where we were before, the trend ranking is probably a little bit more important, because our algo process was not working, especially when we started going long. We had a long trade right in here that did pay some dividends, didn't work, and we ended up in that trade for a many number of months. But what was happening is that even down in this particular point, as I said before, I said, at this point, we had a composite ranking of 12, which basically is 100%. So you're 100% equities at this point. And then as we get back up to the top, we're now at 72. So you were reducing your exposure a little bit, but you're still keeping a 70% rating on your equities, and then you're going to go back at this point. But at this point, you're only going back up to 90%, and this is the point where everything, as the trend ranking begins to fall down, this is the point where, and this is kind of what we would be looking for today. And as I say, I still think that this is something that probably takes upwards of 6 to 12 months to evolve, of like cycling up and down and breaking down. But at this point here, what's happening is that for each successive rally in the market, you're now reducing your exposure. So you've gone from a 70% weight at the peak down, and then scaled up to 90, and at this particular point you're now scaling down to like a 62% weight in the market, and that weight begins to go back slightly up. So in this particular point, you're at about a 79% weighting in the rankings. You're trying to take advantage of the trading. But what's really interesting about this market, and what we would talk about going forward, is that because we're below our D2 systems, the value associated with trading is much lower. And so in this particular case, what we would be looking for is opportunities to, when you're below this particular line, is putting some stock into, necessarily, waiting on our trade. So in particular, since we're breaking down, it looks like the long side of the system is not working particularly well, is what we would want to be able to do is not necessarily be jumping into the long side of our trades, and probably placing more emphasis on the weights of the flex portfolio, which tends to overweight the timing component when we were above that green line, above this green line, and then tends to overweight the trend model that we have. So the trend tends to be something that's a little bit more important, and that there's not as much opportunity to go back down. But what we can point out here is that as we continue to go back into these weights of 80s and 90s, this is the point where, and again, this is into 2000, and you're already into 2008. This is the point where our trend really begins to decline, what we're seeing is that you know, again, this is a point where the market's around. It's dropped about 10% from the high. This is a point where this is about 9-10 from the high, and at this particular point, what we're showing is, or what we're seeing is that our overall equity ranks are now down to 48. So basically, at this point, you're dropping your equity rankings or your equities down to 48%. And as we go further along down in here, your equity ranking picks up to 50%. So at this point, you only have half your equity position into the money, and at this point, you're now going down to 18%. So between the the end of 2007 and here 2008, you basically started only risking about maybe half to 2/3 of your equity portfolio in this, and if you overweighted the trend rank, then in fact you'd actually be risking less. So at this particular point, the drop in the equity market was somewhere in the neighborhood of about 18-19%. So given sort of the scaling up and down that investors would do, risking sort of half to 19. At this point, you would have probably had a decline of about 10%. And from this particular point, there was the comp rank, basically would oscillate in the sell zone between 2 and 3. So they're indicating that the likelihood of success of trying to time the market was pretty low. So again, this whole process started coming back up, for investors to get back into the marketplace. This is an area here where you would probably be the first point where you would get back into the trading side of the market would be roughly pretty close to this area. And this is where you would begin with 45% equity investment in your portfolio. And as we move into late 2009, 2010, now we're getting back into an environment where it looks like trading is, the market's going to start to be up and down. There's going to be advantages to taking advantage of like cycles within the market. So here's a point where you have a very strong rank. Your composite rank here is a rank of like 57% equity invested. For the next month or so, you get a fairly sizable decline in the equity market of about almost 20%, and now you're going from a lower overall weighting to a 90% weighting in the market. So the point is that the process does work. It's very different with each particular market, but the idea is that you want to add some value. So all the way up the rally that we saw leading up to the 2008 financial crisis, you were invested. You ended up giving back probably somewhere, by the time all said and done, about 10-12%, which was great, and then you were able to jump back into the market without risking any further damage to your equity portfolio. Roughly a little bit before sort of the other signals started to show some robustness, but you became fully invested. So what does that look like for today's market? So I'm just going to fast forward our chart so that we can kind of see where we are today. So the interesting thing that we see today is that we see that we've had a lot more cycling, where it's been somewhat advantageous for investors to kind of be in the market. And in particular, we've seen this almost for the last 12, 13 months, where we've seen a lot of strong moves to the upside, strong moves to the downside. So in the case of where we are in the market today, our ranking system is still pretty attractive, right? Our trend rank has been in the area of 10 or higher, and it's basically not dipped below. The lowest we've seen has been an 8.7. So for an investor who's invested in the market and doesn't want to do a whole lot, the timing would oscillate that around. But the reality is that our overall rank, we've been basically in the market as a buy, dealing with the ups and downs that we've seen the market go through. And from a cycling perspective, you've had a lot of advantage by either flipping into to the ETF short fund and then taking a bit of a decline, or simply just flattening out your position and adding that incremental value added. So in terms of do I think that we're at a top in the marketplace at this point? um, I think that we're starting to see the underpinnings. I mean, our peak trend rank that was made at the recent highs, a couple months ago was 11 versus a trend rank of 19 that we made back in the fall of 2014. So again, what I would be looking for is that we're going to be prepared to take advantage. We're going to be prepared to sit, especially for trend-oriented investors. We're going to sit. We're going to have to probably take advantage of cycling that occurs in the market. We recently just had a short trade on the system, and there's certainly signs out there in the world that say that this doesn't look like a particularly robust market. China's problems, Greece problems, they're short-term solved, but I think that a lot of these things potentially could weigh on this. So what I'm looking for is I'm looking for some kind of 3 to 4 month decline that's likely to occur. At that point, I'm looking for the market to most likely go back, continue to make new highs, and or at least go back very close to the old highs. I think if this was the high that was made recently on the S&P, that this is an area where I think you'll get back to. Or maybe risk, for a trend investor, you might risk sitting out, 3-4% on the downside, and if you're cycling up and down, you're going to slowly be reducing your weights based on rallies up and down. But I still think that we're probably looking at a good 6 to 12 months before we see, sort of the point where this cycle is gonna rotate over. So we'll follow it each day, and we follow it each week and update it. But anyway, this is an example of what the market looks like today and what it looked like before the last collapses that we had.